For the first time in what feels like forever, high inflation is a real problem for anyone with a savings or investment account. So the big question is, what actually works when prices start going crazy? We're going to dive into a century of data to see which investments have managed to survive and which ones actually came out on top. So let me just ask you this straight up. Is your portfolio really ready for this? I mean, after decades of prices being pretty stable, most of us just don't have any experience with this kind of environment. It feels like the rules of the game have totally changed. But the good news is, history has a playbook for us if we're willing to look. All right, so the first lesson from history. Well, it's a tough pill to swallow. It's something we can call the traditional portfolio trap. Basically, all the standard go-to investment advice, it turns out it can become incredibly fragile right when you need it to be strong. Now, this first number is a real shocker, especially if you believe stocks always win in the long run. We tend to think of stocks as a great hedge against inflation, but the data tells a totally different story. During the worst inflationary periods since 1926, the US stock market actually lost you money. We're talking an average loss of 7% a year in real buying power. Ouch. Okay, so what about those safe government bonds? Surely they did better, right? Nope. Turns out they were just as bad, if not worse in some ways. Over those exact same high inflation periods, 10-year Treasury bonds lost an average of 5% of their real value every single year. So much for being a safe haven. And this is where that trap really snaps shut. You take those two assets and put them together in that classic 60-40 portfolio, 60% stocks, 40% bonds, and what do you get? A painful 6% loss in real terms year after year. For the average investor, it felt like there was absolutely nowhere to hide. But it is not all doom and gloom, far from it, because that same historical data also shines a huge spotlight on a completely different group of assets, the ones that have consistently provided real protection against rising prices, the things that actually worked. And the difference here is just, wow, it's staggering. While stocks and bonds were drowning deep in the red, commodities, we're talking things like oil, gas, metals, and agriculture, delivered a stunning positive return of 14% a year after inflation. They didn't just survive, they were literally thriving because of it. So what we're seeing is that history's best inflation fighters look nothing like your standard portfolio. First, as we just saw, you've got hard assets like commodities. Second on the list are these things called active trend following strategies, which have done incredibly well. And third, even things like fine art, wine, collectibles have proven to be a really solid place to park your money. So you're probably asking, what on earth is a trend-following strategy? Well, think of it this way. A big inflation shock isn't like a sudden lightning strike. It's more like a tide that slowly comes in over months or even years. These strategies are specifically designed to catch those huge, slow-moving waves in things like commodities or currencies and just ride them. It's a momentum game, and it works. Okay, so this brings everything we've learned from the past right into today. Looking at all this data, it really forces you to ask the question, what does this mean for your money right now? How should you be thinking about your own portfolio? The people who did this study really said it best. With all the massive government spending and money printing we've seen lately, pretty much everyone agrees that the risk of inflation is way up. So the big takeaway here is that it's absolutely critical for every single one of us to take a hard look at our investment strategy and see if it's still fit for purpose. Of course, here's the billion-dollar question you always have to ask with history. Is this time different? And, it could be. Our economy has changed a ton. We're not building as many physical things in factories. We're writing code and creating digital assets. And those kinds of huge shifts could definitely change how different investments react. And that leads us to the final, fascinating question, the elephant in the room. What about brand new assets like Bitcoin? So many people have called it the ultimate inflation hedge, digital gold. But the researchers here urge a lot of caution. I mean, Bitcoin is still incredibly new and ridiculously volatile. And maybe most importantly, when markets have panicked recently, Bitcoin has often sold off right alongside stocks. That suggests it might not be that reliable safe haven everyone's looking for, at least not yet. It's a brand new player in a very, very old game.